Exam Scholar, Real Estate Edition.
Question 1. This is a type of ownership where an individual owns the airspace of his unit, but the buildings and common areas are owned jointly with the others in the development. A. Condominium. B. Planned unit development. C. Planned condominium development. D. Apartment conversion development. Answer. A. In a condominium, the individual owns the airspace of his/her unit, but the buildings and common areas are owned jointly with the others in the development. Question 2. The original principal balance is best defined as A. The total amount of principal owed on a mortgage before any payments are made. B. The total amount of principal verbally agreed to be paid on a mortgage before any payments are made. C. The total amount of principal owed on a mortgage before any payments are made but after earnest money has been transferred. D. None of these. Answer. A. The best definition for original principal balance from the given choices is the total amount of principal owed on a mortgage before any payments are made. Question 3. This is required on all loans having a loan-to-value of more than 80%. A. A trust guarantee. B. Mortgage insurance. C. Warranty insurance. D. Deed insurance. Answer. B. If a loan has a loan-to-value ratio of more than 80%, mortgage insurance is required. Question 4. A legal document pledging a property to the lender as security for payment of a debt is called A. A mortgage. B. Property insurance. C. Note of indebtedness. D. A deed. Answer. A. A mortgage is a legal document that offers real property to a lender for payment of a debt in real estate. Question 5. This reports the raw data pulled from two or more of the major credit repositories. A. A merged credit report. B. A multiple source credit report. C. A combined credit report. D. A mixed credit report. Answer. A. A credit report that pulls from two or more of the major credit reporting agencies is called a merged credit report. Question 6. The time during which the lender has guaranteed a certain rate is called A. The lock-in period. B. The opportunity window. C. The period sans expiration. D. The evaporation period. Answer. A. The lock-in period is the window of time in which the lender has guaranteed a certain rate. Question 7. Loan-to-value is best described as A. The percentage relationship between the amount of the loan and the appraised value or sales price. B. The relationship between the amount of the loan and the comparable net value. C. The numerical relationship between the amount of the loan and the lowest sales price in the last 6 months. D. The percentage relationship between the length of the loan and the appraised value or sales price. Answer. A. The percentage relationship between the amount of the loan and the appraised value or sales price is called loan-to-value. Question 8. Loan origination is best described as A. A process by the lender in getting new loans. B. A process in which the loan amount is released by the lending institution. C. The originating source of the loan. D. None of these. Answer. A. Lenders typically call the process of getting new loans as loan origination. Question 9. This type of insurance protects against claims against a property owner for negligence or bodily injury or property damage to another party. A. Property insurance. B. Mortgage insurance. C. Liability insurance. D. Life insurance. Answer: C. Liability insurance protects against claims against a property owner for negligence or bodily injury or property damage to another party. Question 10. A nonconforming loan is also called A. A jumbo loan. B. A bulk loan. C. A loan in excess. D. A grant loan. Answer: A. A jumbo loan is also known as a nonconforming loan. Question 1. An examination of title is A. The report on the title of a property from the public records or an abstract of the title. B. The act of viewing the title documents. C. The transmittal of title documents from one person to another. D. The viewing of title document reports by a lender during pre-qualification. Answer: A. An examination of title is the report on the title of a property from the public records. May also be an abstract of the title. Question 2. An escrow analysis is performed by the lender to ensure A. The correct amount of money is being collected. B. The interest rates have not changed. C. The borrower is able to complete the transaction. D. The final earnest monies have been deposited. Answer: An escrow analysis is performed by the lender to make sure the correct amount of money is being collected. Question 3. This conveys title to the lender when the borrower is in default and wants to avoid foreclosure. A. A deed in lieu of foreclosure. B. A deed in transfer of foreclosure. C. A short sale. D. A deed in lieu of default. Answer: A. A deed in lieu of foreclosure conveys title to the lender in the event the borrower is in default and wants to avoid foreclosure. Question 4. What is an agreement in which a borrower receives something of value in exchange for a promise to repay the lender at a later date? A. Credit. B. An IOU. C. A promissory note. D. A contract. Answer: A. Credit is an agreement in which a borrower receives something of value in exchange for a promise to repay the lender at a later date. Question 5. What is an adjustable rate mortgage that allows the borrower to change the ARM to a fixed rate mortgage within a specific time? A. A convertible ARM. B. An exchangeable ARM. C. A balloon ARM. D. An ARM interchange. Answer: A. A convertible ARM allows the borrower to change from an adjustable rate mortgage to a fixed rate mortgage within a specified amount of time. Question 6. Changing the ownership of an existing building to the condominium form of ownership is called A. Condominium conversion. B. Property conversion. C. Ownership change in duality. D. Condominium modification. Answer: A. Condominium conversion occurs when the ownership of an existing building changes to the condominium form of ownership. This usually happens in rentals like apartment complexes. Question 7. This is a term that determines that property acquired by a married couple during their marriage is considered to be jointly owned. A. Community property. B. Joint property. C. Dual ownership. D. Ownership in full. Answer: A. Community property assumes that a property purchased by a married couple is considered to be jointly owned. Question 8. This is any condition revealed by a title search that adversely affects the title to real estate. A. Lien. B. Cloud. C. Judgment. D. Blemish. Answer. B. A cloud on a title is anything that adversely affects the title as determined by a title search. Question 9. An analysis of the transfers of title to a piece of property over the years is called A. A chain of title. B. An ownership trail. C. A chain of ownership. D. A title trail. Answer. A. A chain of title is the analysis of transfers of ownership to a piece of property over time. Question 10. An acceleration clause is most similar to A. A call option. B. A redemption option. C. A retrieval option. D. A default option. Answer. An acceleration clause is most similar to a call option. Question 1. An arrangement made to repay delinquent installments or advances is called A. Repayment plan. B. Settlement plan. C. Debt installment notice. D. Debt division plan. Answer. An arrangement made to repay delinquent installments or advances is simply called a repayment plan. Question 2. The amount of principal that has not yet been repaid is called A. The balance. B. The remaining balance. C. The outstanding note. D. The loan remaining. Answer. B. The remaining balance is the amount of principal that the lendee has not paid yet. Question 3. The process of paying off one loan with the proceeds from a new loan using the same property as security is called A. Refinance transaction. B. Resettlement transaction. C. Redouble transaction. D. Loophole transaction. Answer. A. This type of process is known as a refinance transaction. Question 4. This type of deed transfers without warranty whatever interest or title a grantor may have at the time the conveyance is made. A. Quitclaim deed. B. Warranty deed. C. Trust deed. D. Special warranty deed. Answer. A quitclaim deed transfers without warranty whatever interest or title a grantor may have at the time the conveyance is made. Usually used by family members, divorcing spouses, and people well acquainted with each other. Question 5. The payment change date is A. The date when a new monthly payment amount takes effect on an adjustable rate mortgage or graduated payment mortgage. B. The date when a new monthly payment amount takes effect on an fixed rate mortgage or graduated payment mortgage. C. The date when a new monthly payment amount takes effect on an adjustable rate mortgage or balloon payment mortgage. D. The date when a new monthly payment amount takes effect on an fixed rate mortgage or balloon payment mortgage. Answer. A. The date when a new monthly payment amount takes effect on an adjustable rate mortgage or graduated payment mortgage is called the payment change date. Question 6. What is the definition of a note in terms of real estate? A. A legal document requiring a borrower to repay a mortgage loan at a stated interest rate during a specified period of time. B. A legal document requiring a signature by both buyers and sellers that allows for the transfer of real property. C. A legal document requiring a borrower to repay a portion of a mortgage loan at a stated time in a lump sum. D. None of these. Answer. A. A note in terms of real estate is a legal document requiring a borrower to repay a mortgage loan at a stated interest rate during a specified period of time. Question 7. The interest rate banks charge to their preferred customers is called A. The prime rate. B. The preferred rate. C. The priority rate. D. The graduated rate. Answer: A. The prime rate is the rate the banks charge their preferred customers for loans. Question 8. This is given by a commercial bank or other financial institution for a certain time and certain amount. A. Line of credit. B. Mortgage. C. Note. D. Bank account. Answer: A. A bank or other financial institution gives out a line of credit for a certain time period and for a certain amount. Question 9. This limits the amount the interest rate can increase or decrease over the life of the mortgage. A. A life cap. B. An interest limit. C. A mortgage cap. D. A fixed cap. Answer: A. A life cap limits the amount of change the interest rate can fluctuate over the life of a mortgage. Question 10. This is a type of ownership where individuals actually own the building or unit they live, but common areas are owned jointly with the other members of the development or association. A. Condominium. B. Planned unit development. C. Planned condominium development. D. Apartment conversion development. Answer: B. In a planned unit development, the individuals actually own the building or unit they live in, but the common areas are owned jointly with the other members of the development or association. Question 1. A mortgage that can be assumed by the buyer when a home is sold is called an A. Assumable mortgage. B. Transferable mortgage. C. Passable mortgage. D. None of these. Answer: A mortgage that can be assumed by the buyer when a home is sold is called an assumable mortgage. Question 2. If a person is this, they can use a portion of a fund such as an individual retirement fund, but must pay taxes on funds that are withdrawn. A. Bonded. B. Vested. C. Trusted. D. Insured. Answer: B. A vested person can use a portion of a fund like an IRA, but must pay taxes on the funds that are withdrawn. Question 3. A fiduciary who holds or controls property for the benefit of another is called A. A beneficiary. B. A trustee. C. A grantor. D. A grantee. Answer: B. A trustee is a fiduciary who holds or controls property for the benefit of another. Question 4. A title search would show A. Clouds. B. Rivers. C. Faults. D. Hazards. Answer: A. A title search would show any clouds on the title such as liens or other items. Question 5. An organization that collects principal and interest payments from borrowers and manages borrowers' escrow accounts is called A. A lender. B. A servicer. C. A mortgager. D. A corporation. Answer: B. A servicer is an organization that handles the collection of interest payments and manages the borrower's escrow accounts. Question 6. Ownership does not pass to the survivors in the event of death in A. Tenancy in common. B. A fee simple estate. C. Tenancy in joint. D. None of these. Answer. In a tenancy in common, ownership does not pass to the survivors in the event of death. Question 7. When a lender uses another party to completely originate, process, underwrite, close, fund, or package the mortgages it plans to deliver to the secondary mortgage market, this is known as A. Third-party origination. B. Secondary origination. C. Partner origination. D. Outside origination. Answer. A. If a lender uses another party to either completely or partially originate, process, underwrite, close, fund, or package the mortgages it plans to deliver to the secondary mortgage market, this is called third-party origination. Question 8. What are the two categories of closing costs? A. Recurring and prepaid. B. Non-recurring and paid. C. Non-recurring and prepaid. D. None of these. Answer. C. Closing costs are divided into two categories, non-recurring and prepaid. Question 9. A technique in which a seller deeds property to a buyer for consideration, and the buyer simultaneously leases the property back to the seller is called A. Leaseback buy. B. Sale leaseback. C. Lease to own. D. Sell leasehold. Answer. B. In this type of situation, this action between the buyer and the seller is called a sale leaseback technique. Question 10. A provision in an agreement that requires the owner of a property to give another party the first opportunity to purchase or lease the property before he or she offers it for sale or lease to other parties is known as A. First right of refusal. B. First actionable right. C. Preemptive provision. D. Priority right of action. Answer. A. The first right of refusal provision in an agreement allows the party listed the first opportunity to purchase or lease a property before it is released to other parties. Question 1. If you are looking at the note rate, you are looking at A. The interest rate stated on a mortgage note. B. An amount that has been pre-qualified. C. The rate of depreciation of a real property. D. None of these. Answer. A. The note rate is the interest rate that is stated on a mortgage note. Question 2. The National Association of Realtors, NAR, is affiliated with which of the following? A. The American Institute of Real Estate Appraisers. B. Institute of Real Estate Management. C. The Farm and Land Institute. D. All of these. Answer. E. The National Association of Realtors is affiliated with 9 institutes, councils, and societies. The American Institute of Real Estate Appraisers, the Institute of Real Estate Management, and the Farm and Land Institute are 3 of these affiliates. Question 3. What causes the real estate market to be considered inflexible? A. The lack of control of factors determining values of property. B. The immobility of land as well as the time required to develop new properties. C. The ability to quickly react to market demand fluctuations. D. The similarities of properties in a general geographic area. Answer. B. Because each property is unique in real estate and cannot be moved, this creates a slowness to respond to market demand. Question 4. Uniqueness in real estate properties is sometimes called A. Situs. B. Conforming. C. Self-same. D. Unvaried. Answer. A. Situs is a term of law, originally meaning site, where the property is treated as being located for legal purposes. This uniqueness of place in real estate is also called situs. Question 5. The mortgage that usually has priority is A. The one that has been recorded first. B. The one that has no prior liens affecting its priority. C. The one that is executed first. D. None of these. Answer. A. The priority of a trust deed or mortgage is established by recording. The one that is recorded first gets priority. Question 6. If an agent is to get the commission for a long-term lease, the commission would be paid out. A. Immediately for the full amount of the lease. B. Each month over the life of the lease. C. In a lump sum for half the lease amount and monthly thereafter. D. None of these. Answer. B. Typically, the lease compensation is calculated based on the full and total amount of the lease but paid out monthly over the term of the lease. However, in extremely long leases, the compensation is typically paid out monthly for the first few years of the lease and a lump sum thereafter. Question 7. In order to set commission rates, the contract between the principal and broker should A. Be in writing stating rates are set by statute. B. Be in writing stating that rates are negotiable. C. Be an oral agreement if not written. D. None of these. Answer. B. Commission rates are not set by statute. The commission rates between the broker and principal are negotiable. To establish this and avoid lawsuits, this should be in writing. Question 8. If a mortgage note was executed and a new loan was established on the same property at a higher interest rate, the prepayment penalty could be A. Waived due to recouping losses through a higher interest rate. B. Waived because of the understanding nature of the lender. C. Charged regardless of any interest rates. D. None of these. Answer. A. Because a prepayment penalty is instituted by a lender to recoup any lost interest charges due to early payoff of a mortgage note, a lender could waive the prepayment penalty if a new loan on the same property is issued at a higher interest rate. Question 9. If an advertisement is offering a secured loan, the ad must include A. The loan is secured. B. To what extent the loan is secured. C. How and to what extent the loan is secured. D. Who is securing the loan? Answer. C. Disclosure of how and to what extent a loan is secured must be included in any advertisements offering secured loans. Question 10. If a farm is sold that has a full crop of annual vegetables ready to be harvested, what conveys as real property? A. Trees. B. Air rights. C. Mineral rights. D. All of these. Answer. D. The annual crops are considered personal property of the person who planted them. The trees, air rights, and mineral rights convey with the sale of the property.
Exam Scholar, Real Estate Edition.